Right now, Brian, I'd say, a 1% pullback out of the NASDAQ isn't exactly scaring me. I doubt if it's scaring too many people. But I do think people relaxing a little bit when they see, positive catalysts in the market, they come back in. When they don't, they might ease back. I think this is one of those easing back periods right now, not just both hands out selling.
Okay, well, Brenda, I didn't want to say we need to be afraid. That it's not fear. All I'm noticing is that, in the last couple of days, when we've had downside or even when we've had upside, the NASDAQ has either led us on the downside or lagged on the upside. It's not a trend. A few days doth not a trend to make, but I would imagine, given tech's importance to the overall market, it's something you're watching?
Certainly something we're watching. I mean, we can't deny that technology has really become an essential service, and especially in this new environment that we're in. And they also are for the most part, very healthy companies with strong balance sheets. So people have been gravitating there and, not surprising. But I think what we've seen over the last few weeks and even over the last couple of months is we have had days when investors are starting to look outside of tech because there are a lot of values there. Certainly many of them depend on the economy recovering much more than we've seen thus far. But we can't deny that there are opportunities outside of tech. So I think that tech has been an incredible driver of the market. We're not ready to say get out of tech at this moment, and we're likely to continue holding the names we have for the foreseeable future. But in terms of putting new money to work, I think there are other opportunities in the market.
Well, let's follow up with you, Brenda, on that, because value has been outperforming growth over the last couple of sessions. Value can sometimes equal boring. We've talked about companies like Church & Dwight and Clorox and McCormick Spices, one of Jim Cramer's favorites. I'm not calling those companies boring, but the idea is they're kind of not sexy. Where are you seeing value right now with your team at Sandhill?
I think you can still have somewhat sexy and more value-oriented in this stock pickers market like we have today. So, names like Disney, which is really tied to an economic recovery in many respects, and has a great, incredible business, incredible content. It can't be repeated anywhere. They have incredible moat around that company. Other companies like Honeywell, a great company to own within the industrial space. High quality, solid balance sheet, potentially poised for making acquisitions in this type of environment, but again, much more dependent on the economy. But it's those kind of ideas that I think it makes sense to pick away at in this environment when they're still down and out, and when we start getting more signs that we're able to reopen a little bit more good news perhaps on the vaccine front. Those could certainly be catalysts to get those stocks moving the right direction.
All right, so Stephen Weiss, and we'll get to Jim in a second. Stephen Weiss, to you, you sent out an email. I can't read everything because there's words I'm not allowed to say on television that were basically in the email, but the gist of your email was that beep, beep.
Well,
no,
in fairness, those words were directed at you, not at the market.
Well, of course, that's what I mean. It was best of love and hope you're well. Beep, beep. Anyway, no, just curious, you seem to not really agree with what the market is trading on, right? What do you believe is the trading driver of the macro markets right now?
Look, there are always inefficiencies in the market since the market came into existence. That's the way it's going to be. And despite Eugene Fama saying that there's an efficient market hypothesis, I think that's absolute crap. And Warren Buffett says the same thing, as does Jim Simons, whose average is 66% annual return. So the inefficiencies are just so blatant here. So the market's trading on retail and the Robinhood phenomena. The market is trading on basically ETFs, which just have volume coming in, so they drive certain things. It's trading on relative value. But that creates opportunity. So it's not a terrible thing. Take today, for example. Taiwan Semi, which was my final trade yesterday, they put a blow-away quarter in. They had revenue growth, revenue growth 29%, earnings growth of 88%. They beat estimates on the bottom line by 40%. In normal times, in times that markets trade more in fundamentals, that would lift the entire tech sector because it's a read-through. It's a read-through to Apple. It's a read-through to Skyworks, where 51% of their business comes from Apple, and Apple's primary contract chip manufacturer is Taiwan Semi. So Taiwan cited 5G. You would think that would lift the stocks. Now we're talking about one day, maybe we're talking about a few days. So I see value in the tech sector, and that's going to be ratified and proven out when they report earnings, just like the last quarter. I don't see it in the companies that are depending upon a vaccine. That's going to take years to convince the majority of individuals to take that vaccine. So you can talk about the airlines, which are defunct, talk about the hotels. I mean, these are upside down. The morons that are going out and giving Norwegian cruise lines more money, that equity is going to be worth nothing. So there's got to be, that's opportunity. Now, you can't short a lot of these stocks. There's no borrow. And frankly, I think from a karma standpoint, it's bad to short them in this environment because these are not errors by the management. These are unforced errors in the airlines and the cruise.